Welcome to Richie Shot.
This week ended with a lot of developments. From gold surge to oil, from sanction proposals to Nasdaq. Here is what you need to know to end the week. If you're ready, let's dive in. Nasdaq hits fresh peak as Fed rate cut bets fuel tech rally. Wall Street capped the week on a high note, at least for tech. The Nasdaq Composite climbed 0.4% Friday, powered by gains in Tesla and other growth names as investors doubled down on expectations the Federal Reserve will ease rates next week. The S&P 500 barely budged, while the Dow Jones Industrial Average slipped 166 points, or 0.4%, weighed down by blue chips. The mixed session followed a historic Thursday, when all three benchmarks closed at record highs and the Dow topped 46,000 for the first time. Momentum is still firmly in place. The S&P 500 is tracking its best weekly run since early August, and its fifth positive week in 6. The Nasdaq, meanwhile, is on course for a second straight win, while the Dow is breaking a 2-week losing streak. The backdrop is softening labor data and cooler inflation, just the mix traders want heading into the Fed's September meeting. Futures markets are assigning near certainty to a quarter-point cut in the benchmark rate, betting policymakers will pivot to support growth. That prospect has given tech a tailwind, but it also sets up a delicate balancing act. How much easing before inflation fears reignite? Gold shines brighter. Fed bets push bullion to historic heights. Gold is having a moment, and not just any moment, but one for the history books. After setting a fresh record on Tuesday, bullion is heading for its fourth straight weekly gain, climbing nearly 2% this week to hover around $3,650 an ounce. That makes gold one of the year's standout assets, up an astonishing 39%, comfortably outpacing the S&P 500 and leaving most commodities in the dust. What's fueling the rally? A cocktail of weaker U.S. labor data, sticky inflation, and growing conviction that the Federal Reserve will cut rates as soon as next week. Futures markets are now pricing in at least a quarter-point cut, with the possibility of 2 more before year-end. That easing bias, combined with steady central bank demand, geopolitical jitters, and inflows into gold-backed ETFs, has turned the metal into the go-to hedge. Beyond breaking nominal records, gold has also eclipsed its inflation-adjusted peak from more than 4 decades ago. In other words, this isn't just a shiny headline, it's a structural story. Whether the Fed follows through or not, investors seem convinced. In uncertain times, all that glitters is still very much gold. Oil slips again as supply glut outpaces war and demand fears. Crude markets are feeling the squeeze, but not the bullish kind. After Thursday's sharp drop, oil prices extended losses into Friday, albeit at a slower pace. Brent crude slipped 30 cents to trade near $66.07 a barrel, while West Texas Intermediate lost 31 cents to $62.06. Both benchmarks had already tumbled 1.7% and 2% respectively in the previous session. The trigger? A monthly report from the International Energy Agency projecting global supply will rise faster than expected this year, thanks largely to OPEC+ production hikes. That forecast overshadowed ongoing concerns about Middle East tensions and disruptions linked to Russia's war in Ukraine. OPEC, for its part, struck a more optimistic tone, leaving demand growth forecasts for 2025 and 2026 unchanged and pointing to a resilient global economy. Yet behind the scenes, Saudi Arabia has been pushing for higher output to reclaim market share. The group's decision to raise quotas starting in October reflects that strategy. Trade sources add that Saudi crude exports to China will climb sharply next month, with state giant Aramco set to ship around 1.65 million barrels per day, up from 1.43 million in September. That surge underscores how supply dynamics are outweighing geopolitics in shaping oil's short-term trajectory. Tether steps into the U.S. spotlight with fresh leadership and a new token. Tether, the world's largest stablecoin issuer, is entering a new chapter with a strong U.S. focus. The company has appointed Bo Hines, a former White House digital asset advisor, as CEO of its dedicated U.S. arm, while also unveiling a new token tailored for American institutions. The moves highlight Tether's growing commitment to engagement with regulators and policymakers at a time when the U.S. digital asset landscape is opening up. Hines, who previously led the Presidential Council of Advisors for Digital Assets, brings both political know-how and regulatory experience, signaling a bridge between Tether and Washington. Alongside the leadership change, Tether is launching USAT, a token designed to operate under the GENIUS Act framework. Unlike the global-facing USTD, USAT will specifically serve businesses and institutions that want a stablecoin fully aligned with U.S. oversight. Taken together, these steps reflect Tether's effort to evolve into a trusted partner for regulators, lawmakers, and enterprises alike. Far from just defending its market dominance, the company is now positioning itself as a builder of bridges between crypto innovation and the U.S. financial system. U.S. pushes G7 for tougher tariffs on Russian oil buyers. Washington is turning up the heat on Moscow and calling on its closest allies to do the same. The U.S. is urging fellow Group of Seven nations to impose tariffs as high as 100% on China and India for their purchases of Russian oil, a move designed to squeeze the Kremlin's revenues and pressure President Vladimir Putin to end the war in Ukraine. President Donald Trump underscored the tougher stance on Friday, telling Fox News his patience with Putin is running out fast. He hinted at sweeping new measures, including sanctions targeting banks and fresh restrictions tied to oil and tariffs. The proposal, shared with G7 partners, goes beyond trade penalties. Washington is also encouraging allies to build a legal framework to seize frozen Russian sovereign assets, worth about $300 billion globally, most of it in Europe, and potentially channel the proceeds to support Ukraine's defense. If adopted, the package would mark a significant escalation of the West's economic strategy, leveraging tariffs and assets not just to contain Russia, but to actively fund Kiev. For the G7, the message is clear. Financial tools are as central to modern warfare as troops and tanks.